Welcome back, everyone. I'm Jordan Giesige, and this is The Limiting Factor. The One Big Beautiful Bill Act was passed on the 4th of July, and it contained an entire section devoted to the termination of Green New Deal subsidies on EVs, solar panels, grid storage projects, and more that were part of the Inflation Reduction Act of 2022. The question for Tesla investors is, how will the new tax credit rules affect Tesla's vehicle, battery, and grid storage businesses? Today, I'll walk you through the impacts based on my interpretation of the bill and interpretations and forecasts from industry analysts. Before we begin, a special thanks to my Patreon supporters, YouTube members, and Twitter subscribers, as well as Rebellionaire.com. They specialize in helping investors manage concentrated positions. Rebellionaire can help with covered calls, risk management, and creating a money master plan from your financial first principles. Let's start by setting some expectations. First, on screen is a high-level summary of the key modifications and termination dates of the Green New Deal subsidies in the Big Beautiful Bill. Not only is this table high-level, it also doesn't include other changes in the broader bill that could have first or second order impacts on Tesla. I will cover some of the other changes in this video, but given the number of changes in the bill and the complexity of the potential impacts, I'm going to focus on what I think is most relevant. By implication, that means I won't be covering impacts of the bill that other people might consider important. Second, it's going to take months before we have a full understanding of the bill because it still needs to go to Treasury for guidance on how the wording should be interpreted and therefore its implications. Third, the forecasts I provide today are from reputable sources, and where there aren't forecasts, I'll provide my thoughts on how each product will be affected. But as always, this isn't financial advice, and do your own research. As they say, all forecasts are wrong, but some are useful. Starting with the worst impacts first, the bill removes all the customer tax credits for used, new, and commercial EVs. That will increase the cost of Tesla's used vehicles by up to $4,000 and the cost of their new vehicles by up to $7,500. There was also a $40,000 credit for vehicles like the Tesla Semi, but that hasn't hit volume production yet. Benchmark Mineral Intelligence and Row Motion are forecasting that's going to kill the growth of EV demand in the next 2 years, with growth returning after 2027. However, their graph comes with 3 caveats. First, it was created before the details of the Big Beautiful Bill were finalized. At the time the forecast was made, Benchmark and Row assumed that the tax credits would be in place until the end of 2025. They're now going to end on September 30th. That's worth noting for completeness, but would likely have minimal impact on the forecast. Second, the article and graph don't appear to take into account that the bill includes a provision for deducting interest from auto loans for vehicles made in the U.S. The interest on a $40,000 vehicle would be around $6,400 on a 5-year loan at a 6% interest rate. For the average taxpayer, that will save about $1,400. Not huge, but still significant. Third, the graph takes into account new emissions policies. I'm not sure how those changes will affect customer purchasing options and decisions, but they'll certainly affect Tesla's bottom line. What do I mean by that? Tesla earns billions of dollars per year from regulatory credits, also known as zero-emissions vehicle or ZEV credits that are sold to manufacturers of vehicles with internal combustion engines to offset strict CO2 emissions rules. A Congressional Review Act, or CRA, recently revoked California's ability to enforce stricter emissions rules, and in doing so also revoked that ability in other states that were following California's lead. Due to that, states can no longer require automakers to buy ZEV credits to comply. At least that's the assumption for now, because it still needs to fully work its way through the courts. That is, the Big Beautiful Bill, combined with the recent Congressional Review Act, not only introduces changes that will reduce Tesla's vehicle demand, but also reduce the profitability of the company as a whole. More detail on that later. With the negative impacts out of the way, let's take a look at the potential silver linings of the bill. First, Tesla is the highest volume EV maker in the US and the only one that's profitable. As much as the Big Beautiful Bill makes life difficult for Tesla, it's going to be even more difficult for the other automakers. That will thin the field, increase Tesla's market share, and therefore increase their scale and reduce their production costs relative to other EV makers. Second, this isn't the first time Tesla's had to sell their EVs unsubsidized. In 2018, Tesla vehicles lost access to the original EV tax credit because they started producing more than 200,000 vehicles per year. Over the course of the next 2 years, the EV tax credits were completely phased out. So from 2020 to the beginning of 2023, when tax credits became available again from the Inflation Reduction Act, Tesla was selling vehicles without tax credits, and very profitably at that, thanks to low interest rates and COVID money from the federal government. Yes, this time it'll be more difficult to sell their EVs profitably because the money supply is tighter and Tesla's losing the ZEV credits. But there's still a good chance that Tesla can maintain the profitability of their EV business despite the passage of the Big Beautiful Bill. Again, more on that later. Third, Tesla has plans to introduce more affordable vehicles, which may help offset a potential loss in vehicle sales from the termination of the EV tax credits, or even increase their vehicle sales. Those vehicles should be imminent, but they may now be waiting until after September 30th to roll those out, so it doesn't interfere with selling their higher-cost vehicles before the customer tax credits expire. The fourth silver lining is reputational. Many people have an axe to grind with EVs, in part due to EV subsidies. In my view, that's an argument that lacks awareness because it ignores the subsidies that go to internal combustion vehicles. But nevertheless, removing all subsidies from EVs takes that argument off the table and builds the credibility of EVs. Fifth, only 1/3 of Tesla's vehicles are sold in the U.S., which limits the impact of a potential loss in vehicle sales and, to a smaller extent, regulatory credits. The next impact of the Big Beautiful Bill is on battery production. The $35 cell production tax credit and $10 module production tax credit will remain in place, but the rules around those credits have become more restrictive. For example, the cells and modules have to be produced in the same facility, and more of the material that goes into them have to be mined or manufactured in the U.S., or be sourced from a non-China-based supply chain. As I said earlier, some of this is still uncertain because the bill needs to go to Treasury for interpretation. I've read several articles on the topic, and each article comes to a slightly different conclusion. I also spent 4 hours myself trying to make heads or tails of the bill, but I made little progress, and I wasn't even certain that my conclusions were correct. I also tried using LLMs like Grok and ChatGPT, but the interpretations proved unreliable. Regardless, whether more of the input materials and components for battery cells and packs have to be sourced domestically or simply from a non-China source, it's clear that qualifying for the battery production tax credits is now more difficult due to tensions with China. So how does Tesla stand with regards to those supply chain challenges? With regards to producing cells and packs in the same facility, Tesla's already on top of it. They have 4680 cell and pack manufacturing at Giga Austin and prismatic LFP cell and pack manufacturing in Nevada. With regards to domestic or non-China sourcing, depending on the year and which interpretation you're going with, Tesla has to ensure that 40 to 85% of the production inputs are sourced within the US or outside of China. In the last earnings call, Tesla said that they had multi-sourced every component of the 4680 battery cell, meaning that they have supply paths for each component from at least 2 different countries of origin. That is, their 4680 production is fully decoupled from China. However, let's assume that the new legislation is saying that 40 to 85% of the production inputs have to be not just from non-China sources, but domestically sourced. If that's the case, it would certainly be a grind for Tesla, but doable. Depending on the chemistry, the cathode of a lithium-ion battery makes up around 30 to 55% of the cost of the cell or battery pack. Tesla's already working on in-house cathode manufacturing. If that ramp is successful, the cathode production alone would get them most of the way to a 40 to 85% domestic content requirement, allowing their in-house cell production to access potentially billions of dollars of tax credits in the next few years. But that all depends on Tesla's ability to execute on cell and pack production as well. Tesla still needs to ramp their battery production lines. As far as we're currently aware, Tesla hasn't yet been able to ramp production of their fully dry 4680 cells, and Giga Nevada will probably take at least a year or two to hit volume production, if everything goes well. What all that means is that we need guidance from Tesla at next week's earnings call on the progress of their in-house cell and pack production, because it will affect their ability to access the subsidies that weren't canceled by the big beautiful bill. As a final note, for reference, my understanding is that most of the materials used in the cells that Tesla buys from Panasonic at Giga Nevada are from non-China sources, such as cathode material from Japan. So that factory is in a good position, but it would be good to get confirmation from Tesla that it will continue to receive the tax credits after Treasury interprets the bill. That matters because Tesla splits those tax credits with Panasonic, 50-50. Moving along, but still on the topic of batteries, is the implication of the big beautiful bill for Chinese battery manufacturers. Steve Levine of The Electric reported that Chinese companies could own up to 40% of a joint venture with American companies to produce cells and batteries. I confirmed that there is wording in the bill to that effect. As long as those joint ventures meet the rest of the supply chain requirements, they could access the production tax credits. If that's correct, then the implications would be massive for the U.S. battery industry and battery supply for Tesla. We could see Chinese companies building battery cells and packs in the U.S., along with rebuilding supply chains through the U.S. to support them. Batteries are a strategic product, and this could invigorate the battery industry in the U.S. with investment and knowledge transfer. And for Tesla, it would mean a more robust domestic battery supply chain to tap into. Let's move on to the impact of the big beautiful bill on Tesla's grid storage business. The good news is that the production and investment tax credits for battery grid storage projects remain. The bad news is that the investment tax credits, like the production tax credits, come with additional restrictions related to Chinese content. Furthermore, solar and wind electricity generation projects weren't as lucky as battery grid storage projects. The big beautiful bill guts the pipeline for solar and wind projects because over the next couple of years it terminates or phases out production and investment credits depending on when the projects finish construction. Roughly half of battery energy storage projects are paired with solar and wind, meaning products like Tesla's Megapack can expect to lose contracts for some of those projects over the next couple of years as the tax credits phase out for solar and wind generation. But again, there is a silver lining for Tesla. First, as I said, only half the U.S. grid storage projects are tied to solar and wind. But only half of Tesla's grid storage business comes from the U.S., which blunts the impact to maybe a quarter of Tesla's Megapack business over the next couple of years, which is growing globally and could be recuperated. Second, as Jigar Shah points out, who was the former director of loans at the Department of Energy, it's all about the batteries. solar and wind are just the cheapest source of fuel for those batteries. Batteries can use electricity from any generation source, and the generation capacity of the grid is only around 50% utilized. That means there's no shortage of power to charge up battery packs during low demand periods so they can be discharged during high demand periods, reducing the need for more power plants. And the cheaper and better batteries get, the more power plants they can either displace or defer. That is, so long as Tesla is able to meet the non-China-based or domestic content requirements of the Big Beautiful Bill. My view is that the demand for megapacks should remain solid over the coming years. The only concern I have is lumpiness in the order flow over the next year or two due to the multi-billion-dollar rug pull the Big Beautiful Bill just did on the electricity project pipeline, because those projects take several years to design, permit, and start construction. Again, this would be a good question for next week's earnings call. How much does Tesla expect the Big Beautiful Bill will affect their megapack pipeline? Even if the interpretation isn't in from Treasury yet, Tesla should have an initial understanding of how it could affect their order book. Lastly, as a side note, given that I did a video on EOS Energy a few weeks ago, it's worth noting that EOS is extremely well positioned to take advantage of the tax credits in the Big Beautiful Bill. Most of the new restrictions around batteries, packs, and projects are related to Chinese sourcing and ownership, and EOS batteries are over 90% US made. Like Tesla, EOS may still be affected by the disruption to the electricity generation project pipeline, but EOS still has to scale and grow into their order book, so the disruption may be minimal. In summary, let's take a look at the potential profit impacts of the Big Beautiful Bill on Tesla. In 2024, Tesla's regulatory credits were worth about $2.7 billion. Estimates are that around 75% of those came from the U.S., which would come to $2 billion in U.S. regulatory credits. Tesla's net income in 2024 was around $7 billion. If we subtract out $2 billion in regulatory credit revenue, minus taxes, the new net income would be $5.5 billion. As for the impact of the loss of the customer tax credits on EV sales, at this point it's difficult to know. In the short term, we may see an increase in Tesla vehicle sales this quarter as people take advantage of the EV tax credits before they end on September 30th. After that, Tesla's anticipated new affordable vehicles may start to ramp and further offset the lower demand and/or profit resulting from the end of EV tax credits. Another factor to consider is whether Tesla is able to ramp in-house cell production in the next year or two, meet the supply chain requirements of the Big Beautiful Bill, and qualify for $45 per kilowatt hour of production tax credits. If they can, it could offset the lost revenue from ZEV credits. For example, if they produced 45 gigawatt hours of battery cells per year, it would provide $2 billion in production tax credits. That would easily make up for the $2 billion of lost regulatory credit revenue, or allow them to lower the price of their products and make it up on volume. As for the grid storage business, most of the tax credits remain there as well. So as long as Tesla can meet sourcing requirements, there shouldn't be a major impact to profitability. Either way, zooming out to the larger picture, Tesla is increasingly diversified, and the potential losses in EV and grid storage profits from the Big Beautiful Bill will likely be dwarfed in the next few years by profits from their robotaxi business, the ramp of the Tesla Semi, and ramping their energy storage business in China. With all that in mind, for me, what's more interesting about the Big Beautiful Bill is its effect on electricity generation over the next few years and how that might affect Elon's AI ambitions. If you'd like me to do a video on that, let me know in the comments below. If you enjoyed this video, please consider supporting the channel by using the links in the description. Also, consider following me on X. I often use X as a testbed for sharing ideas, and X subscribers, like my Patreon supporters, generally get access to my videos a week early. On that note, a special thanks to my YouTube members, X subscribers, and all the other patrons listed in the credits. I appreciate all of your support, and thanks for tuning in.